Hey folks, I'm taking you down the six-figure financial rabbit hole that is my $257,000 dividend stock portfolio. And oh my God, did I do a lot of deleveraging, de-risking this week as I kind of finalized two of my major trades that I started at the beginning of this year and one that started last year. And of course, I'm talking about BABA and MindMed here, guys. But before we dive too deep down into this, in the clarity of my six-figure transparency, do the channel a favor, hit that like button, folks. Let's zoom out here and get right into this. Now, we have a lot to go over, so to no bullshit you, I'm going to get into my individual brokerage accounts toward the end to show you guys how it actually looks in real life. But at the general overview of the portfolio, many of you may recall, not even a week ago, guys, I had over 18% of my portfolio in aggressive growth plays, which I'm not a huge risk guy, but I always imagine that my aggressive growth money is like walking into the casino and throwing it on a roulette table. And I was not comfortable, with $250,000, 18% of that being largely leveraged into high risk. And I had a few catalysts I was waiting for to play out, and they have finally played out to the decisions leading me to selling a couple of these stocks. So let's start with the two major trades. The first one, of course, being Ali. BABA, I leveraged $10,000 from my line of credit into this stock pretty much only 2 weeks ago at around $227 a share, with the main catalyst being earnings that we just got through. And those earnings were exactly as I predicted, buster, but it didn't do much or reflect on the stock price. So I was still lucky to be trading up 17%. I wanted a 20% return, but I'm not willing to gamble that bank's money moving forward. So I pulled that risk off the table. I pocketed about $1,600 in gains, which is super awesome, guys. But going back to the overview, we can see my long position in BABA is about $9,600. It's roughly around 30 shares. I will not touch that. I'm going to leave that. I'm going to let that go long. Really glad I was able to take on a bit of risk. It barely cost me anything, and it wasn't even my own money. So I'm glad I caught that risk play there, guys, and made a quick $1,600. Now, the second major risk play that I have deleveraged by 2/3, and this is going to come as a bit of a shock to a lot of you, but of course, I am talking about MindMed here, guys. Now, the catalyst coming up with this one more specifically had to do with the NASDAQ uplisting, and I'm going to make a whole separate video surrounding this, but I have a few concerns leading me to think we're not going to be getting the NASDAQ listing anytime within the first quarter of this year, and that was what was keeping most of my risk on the table, which was over $30,000 in this position, guys. MindMed was my largest position, and I finally said, you know what, I can't be gambling with this much money on a company that makes zero revenue, so I scaled it back drastically here, taking a look at the position now, only making up 4% of my portfolio, being worth about $9,900. So consider subscribing if you want to see the in-depth details to my opinion surrounding MindMed, guys. But deleveraging all of this has left me with a huge pile of cash, over $25,000, at which a lot of it I'm going to have to pay tax on. But what I'm doing with this is trying to re-divvy it up between these pies that I have here, being my dividend pie that sits up over 65%, my growth, which is about to become much larger, that's going to be sitting at around 27%, and then I've also been adding some new high-risk plays to the portfolio. One of them being the stock I talked about yesterday, being Momentous, ticker symbol SRAC, guys. I ended up picking up about $5,000 worth just over the last week alone, guys. So that sits in the very high aggressive growth kind of gamble plays. Before I take you into the individual brokerage accounts, just taking a look at this beautiful pie now, I have about 20 positions, and this is making me very, very happy because this is a very stable portfolio. My dividends are now sitting right around $7,500 annually. After I reinvest this, I should be getting closer to about $7,800 to $8,000 is my goal. But just taking a look, guys, my two largest positions right now are Northland Power and Ryokan, and I'm very happy with these being my largest weighted positions, 11% being Ryokan, which currently is sitting at right around $18, with my average buy price, I believe, being around $17.40. Absolutely love this as a dividend play. And then, of course, Northland Power being one of the first stocks I ever bought about 6 years ago, hit all-time highs today again, guys. So I'm much happier having these dividend plays being my higher convictions because I feel like they're less risky, both being multi-billion-dollar companies. One in the renewable sector both pay monthly dividends, by the way, which makes me feel even better. And two large Canadian companies, one for incredible growth and one for recovery play in my own backyard. So my conviction to my risk on that side of things feels much, much better. And then everything else is so beautifully weighted. A 27% growth rating is primarily tech. It's made up by Apple, Microsoft, Facebook, and BABA. Huge positions, but I want to continue diversifying even farther and just going into the QQQ ETF holdings, guys. I really like the fact that it gives me farther exposure to these companies, but then I'm also getting Tesla. I'm also getting PayPal, which is one that I've been looking at but have no exposure to. And I got hardly any exposure to Google, guys. So instead of having to buy all of these individually, and Amazon, of course, I skipped over Amazon, I really want to own all of these. So I think it's very appropriate to start adding in the QQQ ETF, which also gives me a little bit of a dividend as well. So I'll be dumping about $8,600, $9,000 from my MyMed profits right into this sucker here. So just getting into the individual accounts to show you guys where these are going to be playing out. In my Royal Bank account, this is where I am going to be adding the QQQ ETF, which this thing is doing great. Over the last 12 months, the performance is 34% return. I'm sitting on $36,000 from a starting cost of $24,000, which is just insane. And this is where I also took on my first SRAC position, guys, at a really good cost basis, in my opinion. I think I picked it up in here for what, $22.93. High risk, high conviction. I'm not going to get into that. Go watch my 10x video right now, guys. But this is where I'm adding QQQ, which I haven't bought yet, but this is where it's going to be going. Now, taking a look on the Scotiabank side of things with my tax-free savings account, I am sitting on $2,300 US in gains from MindMed, and which is awesome because all of that came from dividends. I put $800 in dividends in MindMed. It became worth $4,000, and I just sold that off. So dividends just, oh man, they did so well for me in here, which I took 2,000 of those dividend. I took 2,000 of those gains, immediately put it into SRAC to keep the kind of growth conviction going in this account, but not with a lot. Like, I mean, we're talking about huge money here, and I'm taking the other 2,000 and I'm going to be dumping that into the Toronto Dominion Bank to continue finalizing that position up. Now, in my managed account, guys, this is where I'm going to be keeping the rest of my MindMed position. As I told you, the 2,250 shares. This was also where I traded BABA, so we can see I'm sitting on about $15,000 in profits. About $9,300 of that I owe to the line of credit, so that's going to be going there, leaving me with just over $6,000, guys, in cash. That some of that might be used for the capital gains tax I'm going to have to pay, but the largest amount of that will likely just get convicted to a dividend stock. The final account being my RRSP account. This was another thing I was thinking about as well, is moving into this year, guys, I'm going to have some RSP contribution room, about $7,000 worth, and that could defer me from paying some tax on some of my money this year. And I'm probably going to take that money and go ahead and buy McDonald's in this account. As many of you know, this is kind of like my lower dividend US stock account, because this account allows me to not pay any withholding tax. So I'd rather hold my US stocks in here that don't pay as high of a dividend yield. So that's why I really like holding Pepsi and J&J, Kimberly-Clark. This is where I'll keep the rest of my BABA position, because I do like having my growth stocks spread out between all my different accounts, so each account can benefit to some degree here, folks. So putting all of that aside, guys, I am getting a lot of my growth positions out of the way now that I'm pretty much going to own all the QQQ that I want. I'm going to be finishing off TD. I got my new exposure to a high growth conviction play being SRAC, my momentous space company here. And then just taking a look at the general overview right now, guys. After this full adjustment, I'm now about a 27% weighting in tech again, guys, 15% in healthcare now that I've deleveraged MindMed. I'm now at 14% with my real estate investment trust because I took BABA, some of that profit in my TFSA, and I put it into Stag Industrial. So I'm very happy with where that currently sits. I'm at about 14% financials, which, like I said, I don't mind continuing to add to financials because I feel like this overall sector weighting is fairly well appropriate. So this is a good time to remind you guys, if your accounts are this complicated as mine are, it's always really good to be using these spreadsheets to make sure you're not overweighting, you're not over risking, and you're really keeping an eye on the broader perspective of your portfolio. You can head on over to the Chartmaster, use coupon code Passive Income Investor for 15% off. You get access to all this stuff, play around with it, and you'll be supporting the channel as well. But I pass the question off to you guys. How is your portfolio looking? What do you think about me scaling down MyMed and BABA, readjusting the risk in my portfolio? I am very, very happy with this risk tolerance being at around 8 to 10%. I don't want it to be more than that. Now that I've deleveraged a lot of my line of credit, it's going to give me a lot of cash exposure to redeliver into the portfolio. Or if something comes up this year where I get a high conviction, I still be cash heavy, collecting a large sum of dividends. Will I get the explosive growth I've experienced in the past? Absolutely not. But I've reached my goal of getting to $250,000 a lot faster than I could have ever expected. And I would rather protect that money, get a lower weighting return. Because think about it, guys, even if I get a 10% return off this portfolio, that is $25,000. Now imagine I get a 15 or 20% return, guys. Like, holy crap, you're talking about $50,000. So right now I'm much happier protecting that and deleveraging any kind of high risk. And think about it too, if MyMed still becomes a $10 billion company, my $10,000 position still can grow into a $50K or even a $100K position if it can grow into that $20 to $30 billion market cap that I think it has the capability to. So yeah, really awesome stuff, guys. Stay cool, stay awesome, and I look forward to catching you tomorrow.